your view is generally pretty constructive, at least in the what, medium term?
Sure, absolutely.
What would you say?
I would say this is still a bull market. It's my report today I sent out was a long and winding road to S&P 6,000. So I think we can continue to push up higher, but it's going to be with a lot of volatility.
What indicators lead you to that?
Okay, so the volatility part has a lot to do with macro uncertainty. So even though the VIX has retraced a lot of its pop, fixed income vol hasn't moved, currency vol hasn't moved, commodity vol hasn't moved. And when most of the cross-asset volatility measures are still elevated, the market is still exposed to an uh-oh moment. There could be another swoosh lower, or we continue to move sideways. So there's still a lot of volatility, and it makes sense. We got Jackson Hole tomorrow, and we got NVIDIA next week. We got the Fed. It makes a ton of sense. So when you tie it into today's tape, we'll pull them back. Makes sense.
You also look to the cumulative AD line,
yes.
Which is that one of the more bullish indicators we have at the moment?
For me, yes, I think it absolutely is, and it's actually leading the S&P to new highs, right? So the S&P 500 AD line is breaking out. The S&P 1500, which is even broader, right? You get the mid caps and the small caps in there. That's also breaking out, and that's quite interesting. That's actually very bullish on the surface. And the last two times this happened was in 2018. And after Volmageddon, that was that. Sure, so it's funny, like right. And we also kind of have a little vol shock right now. And the previous time after that was in 2020, as we're coming out of the COVID bottom, that first consolidation phase there. So breath broke out at those moments, but the S&P kind of stayed sideways anywhere between 2 and 7 months. So it should lead the market higher. So
that leads you to what I guess we're calling the sort of stealth bull.
Well, opening a door for a stealth bull, yeah. So.
Which would look like what?
Okay, so that's what it would look like. So what a stealth bull market is, and it's thing I think folks need to be aware of when you're talking about breadth, is that the average stock can continue to rally, but the indices themselves can break lower. And the last time that happened, the most significant time that happened was in 2000, when the NASDAQ peaked, the average stock bottomed. And from the low in March, for the average stock, to May of 01, they went up about 30%. And what did the NASDAQ do during that time frame? Went down about 50. S&P went down about 30%. So the market of stocks is much stronger in those scenarios than the stock market itself. So I think that door is starting to open right now. It's not my base case scenario, but I think it's important because in this environment, with a lot of macro uncertainty, I think it's important not to confuse your market call with your stock call.
Is that suggesting to you anything about how the market perceives earnings growth between, let's say, a broader set of stocks versus mega cap tech?
I think there's one way to think about it. I think the one way to think about it is like up until now, the smaller cap stocks, they've been in a bear market. They actually have been in a bear market. I think it's reflective of the economy. But the mega caps have been more reflective of, let's say, the AI trade. Now, with the Fed needing to, people hoping they're going to cut, that should help more companies, the companies that are closest to the economy. So I think I'm answering your question the right way, but that's how I'm viewing it as. There are two different markets here, ones that's impacted more by the Fed and ones that are more impacted by AI.
Right. How about seasonality? Is it as treacherous, do you think, September, as some suggest?
Yeah, and that's one reason why I'm saying it's going to be a long and winding road, right? So every September tends to be bad. We all know this, right? Technicians, not technicians, and I know that. But election years, this time in the election cycle, markets tend to struggle. Volatility tends to rise from mid-August until election day. So there should be some sort of hiccups along the way. It's very rare to see the market rip from this point until election day.
There was also discussion in the midst of this, whatever we're in, 11-day rally, right, best in a couple of years, arguing that it's stealing from the normal post-Labor Day gross up. Yeah. Does that make sense?
That's fair. No, that's fair. And I think that's a huge risk coming to the market right now. And that's why I like VIX call spreads right now, because the risk reward isn't so great. Is coming into Labor Day, it's very possible if he comes back to work, maybe the election dynamics change a little bit. Maybe, Harris's might start winning, and maybe corporate taxes are coming in place. So let's rethink things. There is a risk, for sure, as we head into September, things may change a little bit.
I think one of the main takeaways out of earnings season might be that the election cycle, is weighing on capex, but we haven't really seen clear examples of how it might affect equity behavior.
Yeah, that's fair.